Let's continue the conversation now. Bring in Jefferies chief market strategist David Zervos joins us. What do you think is going to happen in May with the Fed, given all this data we've been talking about, David?
Well, Sarah, I think you and Carl really covered the whole gamut there. You went through JOLTS, you went through the H8 report, you got everything. I think the only thing you might not have brought up was the revisions to the initial claims, which I think people got a little bit nervous about too, because they went up, about 20 or 30,000 off the levels that they were at in the new revisions. Not that those are big numbers, but it feeds your point that a lot of the labor market indicators and the ISM data came out much weaker last week. It was just payrolls that surprised us and got us all a bit worried about the Fed having to go one more. I sort of subscribe to that view, Sarah. I think there is one more in this Fed. I think the level of inflation at 6%, probably dropping to the low fives with the good drop off in past numbers out of the time series. I think that's going to be enough to keep them nervous. 5s and 6s are not numbers they want to see on headline CPI or core CPI. So I think if they get a chance, they'll do another one just for safekeeping, and then we'll be in pause mode and get to see what happens with the data, which, as you say, looks slowing down.
It might all come down to this Wednesday's number, which is CPI, and then Thursday PPI. It feels like a lot of these meetings have been just based on what we're seeing in the days before the meeting in terms of the markets and the economy, David. My pushback on the jobs thing for you is the reason they don't want to see strong job growth at this point in the cycle is because of wages. But on the wage number, we got, 0.27 month over month wage growth. Even the yearly numbers look a lot better than where we were last year. Are high wages really a threat to inflation at this point?
I think that's right, Sarah, although I just think that in their heart of hearts, they're looking at where we sit on inflation at these levels, and these levels are not comfortable for them. Core CPI is going to come in the mid 5s. You've still got core PC in the mid 4s. And, as we know, a lot of the big numbers are going to drop out from last year, and these year over years are going to come down. But it still just doesn't look good on the track record. And the unemployment rate's at 3.5. Are they really thinking that they're missing on maximizing employment? Remember, their dual mandate, maximum employment with price stability. Feels like we got the maximum employment side pretty well buttoned up, if not too buttoned up. Price stability, not so much. So when you just look at it from the dual mandate perspective, if they can get a faster move to 2%, get to their goals quicker, if the market lets them do that, the S&P stays strong, the job market stays strong, I think they get there faster. To the extent that the S&P goes down, the job market cracks, I think they pull back and they stop for a while. But that's not what's happening right now. The S&P's actually had a pretty good quarter, right?